Good morning, distinguished guests, ladies and gentlemen. Thanks for the opportunity to come here and present today. We think it's a very exciting topic. This is our first time presenting at a PIRA event, but based on the organisation so far, we certainly hope it's not our last. One confession I have to make is that I like to have people looking at me when I present. And so, given that the presentation had already been distributed, I tend to slip in a couple more slides into the actual live presentation just to keep you on your toes. However, I fear that's going to work against me today, given the time pressures that we seem to be under, so I may just skip over some of those. So today, you've got two of us presenting, so I'll be talking more generally about risk-based capital, the overview, what it's about, and then my colleague Rashan will be talking about giving some preliminary feedback on the market assessment, which I'm sure many of you have been involved in today. So he'll give you some preliminary findings. Okay, so just quickly, what's the purpose of capital? Why do we have it? Well, it's there to meet policyholders' obligations when premiums have proved insufficient. So it provides that buffer between the premiums collected, the claims being paid, being greater. So having that buffer instills confidence in the company and within the industry, and it's also there because the regulator says you have to have it. There are different types of capital that insurance companies can consider. So the first type we have is the pure accounting capital. And this is what your balance sheet says. It's your just the net assets, basically. It's all the paid-up capital the shareholders fund. We then have the regulatory capital, which is how much capital the regulator says that you need to hold. And this is based upon what level of risk society can accept. It's not possible to have companies capitalized so much that there is zero chance of any company ever failing because the business just wouldn't make sense. So it's a question of a trade-off. It's a question of how much risk can society accept. And then what happens to the company if capital falls below this level. We then have the rating agencies who do their external view based upon the type of business that the company writes. And so therefore it's this external perception of the riskiness of the company. And then finally we have management's own views. This is the people who are inside the business, who know the business best, who have their own views as to how much capital they think they need to be able to fulfill the business plans of the company. So focusing on regulatory capital, there's basically an evolution of sorts. So when I was doing my exams many years ago, the standard approach was referred to as simple formatting, or a Solvency I type approach. So there'd be like a minimum dollar value, or a percentage of premiums, or a percentage of claims, of the outstanding claims. So the focus was solely on the liability side of the balance sheet. Recently, there's been more of a move towards internal capital assessments. This is what Solvency II in Europe is all about. This is trying to focus more on management's view of the capital required. So looking at how much capital they think they need, but this requires a lot of analysis, both by the companies in terms of looking at the potential riskiness, but also by the regulators being able to review and validate all of these internal models. So it becomes a very complicated process. So what tends to happen is that we get this middle ground, or advanced formula approach, or often referred to as RBC models. So Australia did this back in the early 2000s, Singapore followed 2004, Malaysia shortly later, and so therefore it becomes the standard within the region. So we have Singapore. Singapore is looking to expand and enhance its RBC formulas. That's why we got 2013 with RBC 2. We have Malaysia. Sri Lanka is in the process of instigating it. Philippines at the moment, we would argue, is very much within the simple formula approach, despite there being an RBC regime in place. But we're hoping that this will move firmly into the advanced formula approach by 2016. So the key features of an RBC system is that the capital required is commensurate with the risk level. So if you're writing more risky business, or you're invested in more risky assets, then you would need greater levels of capital to support that additional risk. Conversely, if you're writing very stable business and investing in very stable investment, you should need less capital to support it. It's formula-based, so you don't need a lot of actuaries in there redefining the business. It's standardized across the industry. And then this standardization allows greater comparison and transparency between companies. So insurance companies are moving away from this one-size-fits-all type approach where insurers maintain this sort of standard solvency margin. So the view now is much more on a total balance sheet. So we have the value of the assets, we have the central estimate of the liabilities, and then we'll have a risk margin on top of that to get you to some standard level of confidence. So these are referred to as the value of policy liability. Now I'm going to step back briefly from the RBC to look at liability valuation, because I mean the bedrock of the RBC approach is that companies are doing standard, sophisticated valuations upon all of their assets and liabilities. So just again, insurance is a promise, so therefore the reserves are there to ensure that the money is available to pay claims when required. Now, unlike a standard manufacturing business where you build the phone, you build the car, and you know the cost of the components, you know the cost of putting it together, you can add something for your marketing, for your profit margin, for your expenses, and then you can say, well, this is the cost of building that item. Insurance, you don't know the cost of your claims until later on. I mean, I'm offering a policy now, you give me a premium now, I'll pay you out claims, which may be zero, which may be multiples of the premium sometime in the future. So the value of these insurance claims are unknown. So I'm going to do a very simple example. I've got a new company that writes $1 million a year, written uniformly through the year. My loss ratio is 8%, with a payment pattern and a reported pattern. I have some expenses, and then I'm assuming that there's no investment income, no reinsurance. So this is basically cash accounting. So there's no P&L, my P&L with no reserves would look something like this. I have $1 million that's been written, 100,000 paid, 100,000 is my cost of claims, some expenses, the rest is profit. So this company has made $840,000 in profit in year one. And the shareholders are going, great, let's write some more. So 2000, they do the same. The claims paid now have increased to 300,000. So therefore the profits dropped down to 635. But the shareholder was still thinking, yep, great, this is all very good. Let's continue on. So they continue on for 5 years. By the 5th year, we can see that the claims paid have increased from 100,000 to 800,000 in a year. And so the profit has dropped down to 110,000. And so the company said, oh, okay, it's not as profitable as I thought it was going to be. I'm going to stop writing business and put this company into runoff. Okay, so what happens when they put the company into runoff? No new premiums coming in, but there's still claims being to be paid because there's a payment pattern in there. And so we can see that in 2015, the year after they stopped writing, there's no premium, but there's a lot of claims. This company has made a loss of 700,000, and then a further 500,000, a further 300,000. So the fact that the company hasn't held the reserves means that they haven't been recognizing profit. That is actually in line with the ways that the experience has been. So if we were to run this again with reserves in place, we can see that it makes the first year look much less because you're having to put aside money for the unearned premium, for the future claims. So for the profit of the first year is only 30,000. Sorry. Okay. However, what it does mean is that in future years we get much more stable. So this company continues to have 110,000 profit every year. If at the end of 2014 the company decides, okay, they don't want to write business anymore, the company no longer wants to write business anymore, then we don't get those big losses anymore. Rather, the claims are paid from the reserves. So we can see that the profit stops, it becomes zero, but there's no big losses. So if the business stops, the claims can still be paid. Reserving is also a direct link into the pricing, and so if a company sets its claims too low, then the profit release will be too high, which leads to increased competition, which leads to lower premiums being charged, and leads to future losses. However, I don't want to sound all doom and gloom. Reserving is not just the one-sided, you don't want to set the reserves too high either, because if the case reserves are set too high, then the profit release will be too low, meaning that higher premiums will need to be charged, meaning a loss of market share and hence future losses. So it's important to try and get these reserves right rather than being too conservative and too optimistic. So back to our RBC framework. Okay, so on top of these liabilities, we add some current liabilities. And then what's left is a surplus. And then the question is how much surplus is required for solvency. Okay, so the current RBC framework, it looks something like this, where there's in the Philippines, there's a total net worth divided by an RBC requirement, where there's formulas as to what the total net worth is made up of, and then a formula on how the RBC requirement is. However, we'd argue that the focus on the RBC requirement is very much on the capital side, so looking at the fixed income equity charges and the like. Okay, so as I mentioned earlier, that you don't just have a central estimate, you also have a margin on there, and so it's referred to as a probability of sufficiency. So this is to ensure that all companies are filling in the numbers for their RBC on a consistent basis, so that everybody has this same level of consistency which is set by the regulator. Running out of time, so I'm going to skip through some of these so that we can get up to Rashan to talk about the industry findings so far. And my button isn't as responsive as I like. Sorry, so one question on this is, at what point does the regulators set the level of sufficiency? 1 in 200 or 99.5% has been taken as pretty well standard internationally in recent years, but that's not to say that it's the perfect answer, it's just a fairly common one. Okay, with that I shall hand over to Rashan to discuss the current findings.